Welcome to episode 5 of the Trading Bootcamp. In today's video, we're going to be going over what a fair value gap is and how you can use it, how to identify them, what they mean, how they're formed, basically everything about a fair value gap. Now, you've probably heard of a fair value gap before, but probably don't know, the key details of how you can use them. If so, then I would still watch the video because there might be something you can learn. In the description below, I've got a free trading Discord and also a paid Discord. So if you do want to be taught by me one-to-one in a private environment, a lot more specific to you and tailored to your needs, then I do offer a one-to-one mentorship, of course for a fee, okay, where you get taught by me completely in a private environment. Also in the description below is a 3-day free trial to my live streams, which I host every single day. Now, I trade live on Discord every day, New York AM session, 9:30 to 11 AM. Now, in the description, like I say, is a 3-day completely free trial where you're going to be watching me trade live this exact strategy that you're going to be learning over the next month or so. And without further ado, let's get straight on this video and teach you fair value gaps. Okay, now that the introduction is over, let's talk about fair value gaps. So what a fair value gap is essentially liquidity that is left behind in a volatile move. Now, what I mean by that is, if you look on the screen now, you could probably point out to me where the volatile candles are. If not, then there's probably something wrong with you, because we should know this by now. Which of these candles is the most volatile? Okay, we've got this one here, we have got these bunch here, and that. Okay, those are the most volatile candles on the screen right now. If you said any other ones, then I don't know. I don't know, but these are the most volatile candles. Now, what does volatility tell you? Okay, you've got to understand when you're trading. Like, you've got to think deeper than what is on your screen. You've got to think deeper. Why is that candle so volatile, and what is it telling me? Okay, it's not just a candle that's gone up in a large candle. There's got to be a reason for that. Okay, why is the candle done that? You've got to think deeper. Now, in this scenario, if we come back to here, okay, you can see that we were chopping, okay, and then suddenly we dropped. Now, what does that tell you? Okay, you've got to think, what would that mean? Okay, maybe this is signaling a potential trend reversal. Okay, that's what I'm thinking. Maybe we're now going to flip bearish. Maybe I should start looking for shorts. And that is exactly what you should be thinking all the time. Now, what a fair value gap is this gap, which you can see in the market there. Now, if you look at how obvious and how clear that looks, this is essentially just a liquidity void. Now, the way that we identify fair value gaps is it's normally a 3-candle sequence or a multiple candle sequence where the wicks do not overlap. So if you see where I've just drawn this line is the previous candle's low. Okay, the wick comes to that exact level. And now if you look at this candle here, the wick comes to there. So in between is a fair value gap, because it's a gap in the market that no price has been to yet. Price has not touched into this area, okay, because this was just one straight candle down and the candle after failed to fill this gap. Okay, so this is a fair value gap. Now, these can be found absolutely everywhere, okay? This isn't some kind of rare occurrence or something you should be, excited about. These are literally everywhere, okay? There's a bullish one there. There's a bullish one down here. They're all shapes and sizes, bear in mind, they aren't just big. There's multiple different fair value gaps on the screen right now that I can just identify over and over and over again, okay? You get the point. Now, what essentially this means and why they are formed is because of all the orders that were put into this candle during this 15-minute candle. So if you imagine, we started bearish. For some reason, inside this candle, not hundreds, but a lot more orders and a lot more volume was in this candle than any other candle. How do we know that? Just by the size, okay? Clearly, this candle is a lot more volatile than this one, just because of the size. So, you've got to think again deeper. What does that mean? Well, that means that this candle has a lot more orders and a lot more liquidity in than this candle. So, the way that essentially a fair value gap works is during this move down, okay, during this move down where we dropped, okay, and we continue to drop down to this level, where is your entry to get into this, okay? How would you enter this trade unless you were just panic selling? Unless you just press sell here for some random reason, because you were scared, you had FOMO, and you just wanted to get in. There's no possible way of you getting into the market, okay, that's actually, you know, a good entry. So the way I imagine a fair value gap is all of the orders are left behind in this gap, because there's so many people and so much money that's still waiting to get into a short position. If you imagine all these different lines I'm drawing now are millions and millions of pounds, millions of dollars that are waiting to short the market, okay? They're waiting to get in, but they don't want to get in down here because that's in a premium price. They want to get in a discounted price with a good entry. So there's basically 3 stages you should think about. One is seeing the fair value gap, okay? One is identifying the fair value gap and seeing a large displacement candle. This here is so clear and obvious to me, it stands out. It's the first thing to look at on the chart. So firstly, you've identified the fair value gap. The second thing is think, okay, what is this telling me? Well, to me, this fair value gap is telling me that the trend is now going to flip bearish and we are looking to go lower, just because of the momentum down. If this fair value gap was this big, would I have the same mindset? Would I have the same kind of story? No, because it's not volatile. But when you see a candle that's that large and that you know, kind of disrespectful to the market, okay, all these different candles here have been completely disrespected by that one candle, okay? It's basically said, fuck you, I'm coming through, and, you know, price is going lower. That's essentially what it said. So that's the second thing. First, identify. Second thing, what it's telling you. And then thirdly, think, how can I get involved in this move? Now, the way you can get involved in the move is by waiting for this fair value gap to be filled and seeing the reaction. So again, if you imagine all these different lines I've drawn are different orders, okay? So people are waiting to go short. So we wait, and the way it should be taught is we wait for price to come back and fill these orders to then continue lower, okay? Because we know we're bearish. Well, we should be bearish, judging by the candles that we've seen. We have now made up our mind on the second step that we are bearish and we're looking to enter short. So now you've got your bias and you want to enter short, you get in at a good price. And again, what did I teach you on the liquidity video? We use our fib from the high to the low. Okay, anywhere above the black line is a good entry. So anywhere above the 50% level with the fib is a good entry. So anywhere above this line is a good entry. Would you believe it that the fair value gap is also above? So this here is a great entry because firstly, we're in discounted price. Secondly, we've established that we're bearish due to the displacement. And thirdly, we've got a good fair value gap, a good size fair value gap to enter from. And that is essentially how you can set up your own trades, okay? That is essentially the simple way of getting in trades. So you'll see we come back up. Look how we react once we tap in. Okay, so now we've tapped in, we've picked up some orders. We're still picking up orders. Still picking up orders. You can see, how are we reacting to this fair value gap? Okay, you can see that it's holding up like a support zone. Okay, if you imagine this fair value gap now is like a brick wall, okay? Price just can't get past it. And that's because all of the orders that were remaining are still inside of the gap. So every time it goes higher, more shorts are being filled. So every time it goes here, shorts are being filled. It goes higher, more shorts are being filled. And that's why we keep seeing drops down and then pullbacks. And that's essentially how you can use fair value gaps, typically to enter your trades. Now, if I get rid of all of this and give you kind of like a metaphor to how I see them, is if you imagine that price here is a train, okay? This is going to sound, again, it's going to sound ridiculous, like I'm talking shit, but you've got to understand and you've got to listen. If you imagine that price right now is a train, okay? We're currently at the train station, and this is the train station here, okay? Let's say the train station's here. The train is suddenly left without you, okay? Let me get rid of that. The train has left without you, okay? It's shot off and you can't get in the move. You can't get on the train, you've missed the train, okay? It's gone. The move has gone, okay? And why is the move gone? Because we don't enter short positions in premium prices, okay? This is way too low to be entering a short. The move has already happened. That's what you've got to think. Has the move happened? Yes, the train has gone. So what would you do in real life? If you miss the train, okay, this is a very important lesson. If you miss the train or miss the move, what would you then do? Would you end up going home and you know, not getting in the trade? Or would you patiently wait for the next train, which may be in 10, 15 minutes, 20 minutes, an hour? Okay? If you were that desperate to go, okay, and that desperate to get in the move, you would patiently wait. So that is exactly the same thing that we're doing here. So we patiently wait at the train stand. So this line's the train stand. And we patiently wait, you know, maybe half an hour later, an hour later, to get in the move. So we're still waiting. Oh, would you believe it? The train is now back. So the train that you originally wanted to get on, which is price, the train that you wanted to get on is now back. Okay, so do you still want to get on the train? Yes. So we get in. Okay, and we still want to go lower. Because our destination, we still want to target these lows. Or we still want to target, you know, this level of liquidity. So we now get on the train, okay? And we still want to go to the same destination we did before. Okay? And that is essentially the main metaphor and the main way that I see fair value gaps. I think it does hit the CP, I don't even know. Okay, there we go. So eventually, you know, we do get the move down. The train was still going in the right direction and we got on board. That is essentially a very good metaphor of how you should see price. If you've missed the move, then wait. You don't jump in, you don't try and get in. You wait for it to come and collect you. Now, if you don't wait, guess what happens? You get wrecked. Okay? If you're impatient and you get in here, look what happens. You get absolutely wrecked. The market favours those that are patient. And it does that every single time. Essentially, it's just a good area where orders are left behind. And people like to get in the market. So if we look here, where is the fair value gap that stands out to you on this screen? You should be able to spot it straight away, okay? The most clear and the most obvious ones are the best. You see how big and obvious that fair value gap is? Look what happened. Came back down. Look at that reaction. Picked up the orders that were waiting. All these people were still waiting at the train station. They got picked up and it went, okay? And look, they caught the big move. So if your entry's here, look at the move you caught. Very good move. But just because it's been used once, there are still orders remaining here. Okay, this is how it works. This is very key and very important. So you see how this candle only came to this level in the fair value gap. So these orders that were here have now been filled. Okay, but only these orders. Guess what? There's still hundreds of millions of orders in this zone that hasn't been mitigated, okay? It hasn't been filled. Price still has not touched into this gap. So this is an unmitigated gap. So what can we do? This doesn't mean that price will always come in and you know, bounce off, but I'm just giving you examples of how they're used. So this means that if price comes back down to here, we could definitely see another reaction off. What trend are we in? Okay, we're clearly bullish. So is this a good play? Well, again, what do? We draw from the low to the high. Are we in discounted price? Yes, we're in discounted price because we're below the black line. Now, all we simply do is see if price comes back and picks us up. So we're still waiting at the train station. And would you believe it? It picks us up. Okay, and look at the reaction out. Now, we can enter long. Okay, and we're now in the trade. We're now on board the train and we're going to the destination. Okay, and we're just riding the wave. Okay, don't put my stop loss there. You can see we get the move up and we get a bounce, and that is essentially just how they work. Now, hopefully, you know, you're understanding what I mean here. It's just orders and money left behind that creates these gaps. That is going to be it for the fair value gap video. Hopefully you understand what a fair value gap is. I mean, they're pretty basic, but they are very important in my strategy, because over the next few lessons, we're going to be talking about inversion fair value gaps, which is the actual model that you're going to be learning. Make sure you stay tuned, like and subscribe so you do not miss any more of these videos, okay? I'm going to start picking up momentum now. We're going to start getting in depth, you know, and really start learning the basics of the strategy now. I still need to teach you the basics a lot more, but I'm going to start implementing a bit of the strategy now in the next couple of videos, so you can actually start using something in the markets and practicing on the demo etc. Don't forget to join the trading Discord in the link in the description below. Also claim your 3-day free trial so you can watch me trade live. And yeah, I'll see you on episode 6. Hopefully you enjoyed.